Hi, I'm Adrian Gore, CEO of Discovery. It's a wonderful pleasure to be presenting at the InsureTech conference for the first time. And I'm really pleased to present to you our Vitality Shared Value Insurance platform. It really is a synthesis of behavioral science, of actuarial science, and of technology, creating a very different category in insurance and financial services. Our company, Discovery, through Vitality, has for 2 decades, through our roots of health and life insurance, been incentivizing people to live healthier, off the simple purpose of make people healthier. That's what our organization has been built on. And over 2 decades today, I believe that our platform is the largest in the world, changing behavior and pricing that into insurance. As you can see from the chart, we work with over 14 insurers across the world in 24 markets, with I think some of the best companies in the world: AIA, Ping An, Generali, John Hancock, Manulife, Sumitomo, and others across the world. And we've seen considerable growth and success with the model. What's made the model globally relevant has been 3 intersecting trends that I think have been emerging over the last decade or so. Firstly, the understanding that the nature of insurance risk is changing. Secondly, the awesome enabling power of technology. And thirdly, the importance of corporate purpose in the context of social responsibility. I would put it to you that in a COVID world, in a post-COVID world, all of these trends are accelerating dramatically. We're seeing that the importance of lifestyle choices, health and resilience is critical. We're seeing the rush online, and that's fundamental. And then we're seeing a referendum on capitalism, that the issue of purpose, making a difference, is fundamental to the insurance industry. And to an extent, the traditional insurance approach is transactional. It's not engaged with customers, so there's a real opportunity here. The trend I want to talk to is the issue of the nature of risk. And we know now more and more that risk, insurance risk, mortality risk, sickness risk, driving risk, fatalities, are a function of behavior, choices that people make every day. It's not a function of a pre-existing set of risk factors. And we also know from behavioral economics, we also know that people have all kinds of biases in making the wrong choices, and that's important. So, for example, in the context of mortality, we know that just 4 simple choices: smoking, drinking, eating bad, and being physically inactive, drive 4 conditions that account for 60% of deaths, of mortality, and over 50% of the disease burden. So we need to make those changes. We need to get people to make changes in how they make lifestyle choices. And of course, that is the opportunity. I would put it to you that traditional insurance models are fundamentally fragile. They don't take behavior into account, and therefore inherently and actuarially, they're pooling together controllable risk, which is not sound. Insurance is about pooling uncontrollable risk, and they're not engaged with the client. And that is the opportunity, in our sense, the shared value opportunity, because I think the insurance industry is special and wonderful and powerful in the sense that we are completely and totally aligned to our customers. If they're healthier, we are more profitable. If they have less auto accidents, we are more profitable. So we are completely and totally aligned. And therefore, if we use our profitability to fund incentives, and those incentives change behavior, that change in behavior makes us more profitable. And so you get this virtuous cycle. Our insured lives are healthier, we're more profitable, it's good for them, good for us, and good for society. And so you get this virtuous cycle that I think is fundamental in a shared value context. And so that really is the opportunity. How we achieve it in our model is very simple. Our Vitality behavioral chassis sits at the base, and essentially integrating that with insurance organization on top of it, as you can see in the slide. And that is really the fundamental architecture of the product and of the model. Vitality itself, the behavioral model, is really quite simple to the customer. It's intuitive and easy. Based on their certain risk factors, they understand their health. We set a personal pathway for them across all of the wellness silos: physical activity, nutrition, prevention, etc. But I think the cool thing is that they do these things. They earn what we call Vitality points. The points give them a status from blue through to gold, and the status gives them all kinds of incentives and awards, really meaningful rewards, because we're using actuarial surplus to fund those incentives. In fact, the incentives are quite significant. They pay less for the insurance. They get all kinds of other benefits through tech, through travel, through all kinds of things that we've learned correlate with behavior change. The actual platform behind that is quite significant and quite complex. If you peel away the layer of the Vitality behavioral chassis, what you'll find is it's based on our what we call V1 or Vitality One technology. It's globally deployed, it's cloud-based, it's multi-tenanted, multi-language. Really, that is the basis of it. And sitting within it are 4 distinct layers. Firstly, and critically, an actuarial pricing layer that really links together behavior change or behaviors with the pricing of insurance. Secondly, a data layer. We have over 45 million life years of health and wellness data and over 10 billion miles of driving data. We treat that data very, very seriously. It's anonymized. It's used for only the good of the client. It's used with consent and in line with regulations, any market we operate. There's a behavioral layer that focuses on the kinds of behaviors and programs we want. So it could be issues of physical activity, could be disease-specific issues, could be about driving better. And then importantly, there's an incentive layer, working with great technology companies like Apple and others with all kinds of other incentive structures to provide the right kind of incentives for people to make behavioral changes. And those four layers coalesce to create what we think is a very intuitive layer for our customers. A great example of how this kind of coalesces is what we call Vitality Active Rewards with Apple Watch. It really brings together a lot of these concepts. We worked with Apple across many markets across the world in this. And the idea, I think, is very, very simple. It incentivizes people to be physically active each week. They set a goal, a steps goal, and a heart rate goal based on their specific risk factors. And if they achieve their goal, they achieve their rewards. But the power here is that you get the Apple Watch basically for free, and you pay for it monthly, where the monthly payment is a function of how physically active you are. So if you meet all of your goals every week, you don't pay for the watch. And in a sense, what we're doing is creating a loss-framed incentive for physical activity. The power of the device is that it acts both as a useful device to track how you're behaving, but it's also an incentive. It's a powerful, valuable incentive. On the right-hand side of the chart, you will see that through a study done with RAND coming out of the data, we've managed to escalate physical activity in that population group by over 34%. And that was done across different genders, different risk factors, different ages. It's remarkably robust in its outcome. So illustrating the kind of techniques of behavior change we use in the Vitality behavioral model. What we've done then is applied this structure, this behavioral, this inverted T in three distinct industries: health insurance, life insurance, auto insurance. The architecture is exactly the same. Do healthy things by way of health, or drive in a safe way, earn Vitality points, and getting incentivized. And then the integration between the behavioral platform, the actual integration, and the insurance entity takes place automatically. I think the power of the model is it works across the entire value chain of insurance, from attracting clients, underwriting, pricing, behavior change, all the way through to retention and persistency. Let me deal with life insurance first, the Vitality shared value life insurance model. I would put it to you, and I said it before, that I think insurance models, in particular life insurance models, are fairly fragile because they don't take into account the nature of risk. Our model is based on considerable data. I made the point about 45 million life years of data. We have the ability to cut mortality on all kinds of behaviors based on disease type, gender, et cetera, and we have the ability to codify mortality where you correlate behavior to the mortality rates. So the data set is quite substantial in what we're using. The fundamental issue is trying to change the nature of life insurance. On the left-hand side of the chart, what you'll see, and you would know this, is that when you buy life insurance, you get underwritten at a point in time, and then you pay the same premium rate for the next 30 or 40 years. Now, intellectually, that doesn't make sense in the sense that the rate is fixed, yet your behavior changes during the currency of the contract. So over time, you're getting a divorcing of price and risk, and you get instability in the sense that better lives or healthier lives kind of leave the pool. And so there's a divorcing of price and risk. Our approach is very different. We take behavior into account fundamentally. In the middle of the chart, what you'll see is our dynamic pricing model. In effect, we charge people less than the market rate, typically because we take into account the assumption that will change their behavior. And then the premium rates over time, as you can see from the chart, drift down or up based on their behavior. If they are engaging heavily, their premium rates that they pay will drift down, giving them better value for money. The power of it is substantial across the value chain. The model attracts people that want to be healthier, regardless of their state of health, even though they're not healthy or whatever, they want to be healthier. It changes behavior, but critically also, it keeps the right kind of people in the risk pool. And so you get a dramatically powerful shared value equation. Our customers pay less for life insurance, they're healthier, and they enjoy considerable rewards. At the same time, we found from our perspective, our actual value of new business is dramatically higher, can be 10 to up to 50% higher than the traditional model. And so the model is, I think, complex behind the scenes, but to the customer and economic, it's very simple and very powerful. We've had considerably powerful results in scaling this across the world. I made the point about working with some of the best insurers across the world. You can see from the chart, the levels of engagement across our markets are typically between 35 and 50%. So the customers in these markets engage, and it really transforms insurance from a transactional business to one where customers are actively engaged and seeing value in a real sense. And then in the middle and the right-hand side of the chart, you can see that persistency levels are tightly correlated across the markets to engagement. People engage in their health, they don't lapse their policy, they stay in the pool. And when people engage in their health, their claims levels are lower. And so again, you can see the kind of the input factors that drive up the value of the business, the value of new business. And so very, very powerful in the context of life insurance. Let me turn to health insurance and tell you about the Vitality shared value health insurance model. It's the same idea. You're sitting on the behavioral platform, incentivizing people to be healthier, and it integrates into the pricing and the working of health insurance. But I think in health insurance, it's intuitive and fairly obvious. We're trying to make people healthier. And I think you would appreciate if people are healthier for a given state of health, healthcare costs are lower, and that's what we're trying to do. But again, the power here is across the value chain, the selection effect, the pricing effect, and critically, the retention effect. Because in health insurance, as you would know, sick people stay in the pool. It's about keeping the healthy people in the pool at the same time. So the ability through the behavioral chassis to offer value to both healthy and sick provides a very, very robust model. Making the point that if you look at our data, so if you look at healthcare costs, inpatient costs, admission rates, length of stays, and then the effect of total healthcare costs, you can see that are tightly correlated to engagement in the program. As people engage in the program, they go to hospital less, they stay for shorter periods of time, and therefore the overall cost of healthcare is dramatically different between those that engage and not engaged. And then if you look at it by disease type, heart disease, diabetes, and lung disease, the correlations are also very, very tight. But I guess the point that's very critical is on the right-hand side of the chart, what we call lapse rates or persistency. Again, when people engage, they don't leave the pool because they're getting value for money out of the pool. And so you tend to retain people that are engaged in the pool. The sick, you retain anyway in a health insurance pool. So it provides a very strong balancing effect to the risk pool. You know, we saw the value of this during the COVID epidemic. You know, this model was developed 10 years ago and more around really the belief that we could alter non-communicable diseases. But what COVID has taught us is that resilience in the face of infectious diseases is actually the same kind of factors, getting people to be physically active, to eat well, to be resilient. And what you see from the chart there is the relative probability of going to hospital, of being hospitalized, based on your engagement in the program. And whether you look at a person with no chronic illness, age 40 to 49, or someone 60 plus with a variety of comorbidities, you can see the relative probability of going to hospital is dramatically correlated to engagement in the program. In cases up to a 10th chance of not going to hospital if you're highly engaged in the program. And so it provides the ability to really reduce healthcare costs at the same time making people healthier, and again, creating the shared value dynamic. And then thirdly, to make the point about Vitality shared value auto insurance, this is really a fascinating application of the model. You will know that telematics has been around for some time, and we're getting a lot of data about, you know, people using telematics to work on usage-based insurance. We flipped that on its head in the context of Vitality around trying to get people to drive better, make them safer with the same value proposition. Again, it works across the value chain. So you drive better, every single drive is rated based on a beautiful app that resides in the face of your mobile, and you earn Vitality points for driving well, and those points give you all kinds of incentives and rewards. It's exactly the same model. So next slide. The model actually manifests for the customer in a very simple but powerful way. We have two ways of giving value back for driving well and driving safely. One is we call wedge funding, where in effect the difference between what we're charging and the surplus created by people driving well is given back to them in strong incentives. One of them that we use is funding their gas, or 50% of your gas, or a discount of gas. Very powerful incentive. If you drive well, you don't pay for gas. We can do that with an EV by paying for the charging costs, or the second on the right-hand side of the chart is a behavioral approach. You pay a very small fixed premium for your auto insurance, and then you pay a rate per mile, but that rate flexes based on how you're driving. And so we can offer considerable precision and a really powerful behavioral incentive that while you're driving, you can bring down the costs of your insurance. So we are monitoring every single issue, acceleration, speeding, how you're driving, and translating that into a simple point system of safety and how well you're driving. The dynamics, I think, are across the value system. You can see from the chart that the selection effect is powerful. We're attracting people that want to drive better. Behavior change is quick, over 12 months or so, and the second part of the chart is very, very quick. And you get the lapse correlations of persistency. People stay in the pool, tend to drive well. And therefore, the overall effect on the combined loss ratio is around a 10% effect that you can see in the saving. And again, the shared value is powerful. So people pay less for insurance. They get all kinds of incentives, and they are safer. And for us, of course, the combined ratio is a lot lower. The tech is very, very powerful. It has all kinds of abilities. So, for example, we can see from the way people are driving, the way the car reacts, the G-forces, if they've been in an accident. So proactively, we can dispatch emergency services. We have things like driver DNA, where we can actually ascertain who's driving the car based on the behavior of the car. So we know if you aren't driving your own vehicle, that's a security issue. We have the ability to reconstruct the accident. So from the statistics, how the car was hit at what speed, reconstructing exactly what happened, and therefore managing and facilitating the claims process in an accurate way. And so I hope the point I've made is that in three distinct areas, life, health, and auto insurance, the model architecture is exactly the same. The manifestation to the customer is, of course, different, but the power is shared value. Healthier customer, better value, and for the insurer, greater profitability and a very engaged client. So let me end again with the three trends and the issue of purpose. We really are going through a process of capitalism evolving, and I think it's for the best. We're learning about CSR, about ESG, and these are important issues. But to an extent, each one of these steps often incurs costs and requires all kinds of governance. What we're proposing is a simple purpose: make people healthier. And I think the shared value is a very powerful evolution, because what it does do is it does good for society, but it does it by making the insurer more competitive and more profitable. I think it's powerful. It's the next dimension, I think, in that evolution. So I hope I've made the points clearly about shared value insurance. We think it's a very, very powerful category. It is a synthesis of technology, actuarial science, and behavioral science. And I hope the points are clear. It's been a great, great pleasure to present this to you. It's a wonderful opportunity, and we are grateful for all that. Thank you very much for listening, and have an excellent conference. Thank you.